All right, let's jump right into it. A few days ago, the US Treasury and the Federal Reserve made a move that honestly should have been front page news. It was a quiet decision, but one with potentially really loud consequences for the markets, and of course, for your money. So today, we're going to break down exactly what they did, why they did it, and what it all means. So here's the number that started this whole thing: $90 billion. Over just the last 8 weeks, the Federal Reserve has quietly funneled that much money into the financial system. And get this, according to the Treasury's own announcements, they have absolutely no intention of stopping. Now, for months, Fed Chair Powell has been telling us that quantitative easing, those huge money printing programs from the past, was over. He said they were shrinking their balance sheet, not growing it. So that brings us to the big question, right? If this isn't QE, then what on earth is it? Okay, let's dive in and figure this out. To really solve this mystery, we've got to look under the hood of the modern money machine. See, the Fed has a brand new name for this whole operation, but to get what it really means, we first need to understand how this machine actually works. And it's not quite as simple as just firing up a giant printing press. They're calling it RMP, or Reserve Management Purchasing. Yeah, I know, it sounds super technical, kind of boring, and that is almost certainly by design. The name quantitative easing became so controversial, so a new, bland acronym like this helps the whole thing fly under the radar. But the real question is, does it actually function any differently? So how is money actually created these days? Well, forget those old images of giant presses churning out cash. In the 21st century, it's all digital, and it happens through a transaction between the Federal Reserve and the big commercial banks. Let's walk through exactly how this works, step by step. Okay, so first, let's just look at a simplified balance sheet for a big bank, say JP Morgan. On the left side, you've got its assets, things it owns, like cash reserves and treasury bonds. And on the right, you've got its liabilities, basically what it owes to other people, like all of our deposits. This is our starting point. And here's the other side of that coin, the Fed's balance sheet. Now notice those bank reserves? They were an asset for JP Morgan, but for the Fed, they're a liability. You can just think of it like an IOU. It's money the Fed owes to the bank. Now let's watch what happens when they decide to make a move. And boom, the action begins. The Fed decides it wants to pump some more money into the system, so it buys $50 billion worth of treasury bonds from JP Morgan. Now, where does the Fed get this $50 billion? It doesn't. It literally creates it, right then and there, completely out of thin air with a keyboard entry. So take a close look at what happened to JP Morgan's balance sheet. This is really interesting. The total size is exactly the same. All the bank did was swap one asset, those treasury bonds, for another, more liquid asset, cash reserves. No new wealth was created for the bank, it just changed the form of its assets. But here, this is where the real magic happens. The Fed's balance sheet just grew by $50 billion. It created a new asset for itself, the bonds it just bought, and a matching liability, those new reserves, at the exact same time. And just like that, the amount of money in the banking system has officially increased. But there's a pretty big catch. That new money is basically trapped inside the banking system. You and I can't go to the grocery store and pay with bank reserves. For that money to actually get out into the real economy, the banks, who are now sitting on all this low-interest cash, need to lend it out. That whole process, where the Fed's actions eventually trickle down to us, is called monetary policy transmission. Okay, so let's put these two things side by side. Under the old QE, the central bank buys bonds, creates reserves, and its balance sheet gets bigger. And under this new RMP program, well, the central bank buys bonds, creates reserves, and its balance sheet gets bigger. The only real difference is the label they're putting on the tin. Mechanically, they are exactly the same. So there you have it, mystery solved. Despite the new, boring acronym, the Fed is doing the exact same thing it was doing before. It's creating money from nothing to buy government bonds and push cash into the financial system. All right, so we figured out the what. Now for the much bigger question. Why? Why fire up the money printer again right after promising they were turning it off? Well, the answer has less to do with the banks and everything to do with their single biggest customer. And the answer? Well, it really boils down to the US government's biggest problem. It consistently spends way more money than it brings in through taxes. To fill that gap, it has to borrow, and it does that by issuing treasury bonds. And as you can see from this chart, that mountain of debt isn't just growing, it's growing exponentially. And this has created a pretty dangerous spiral.
I mean, today, a staggering 20 cents of every single tax dollar collected goes just to pay interest on debt that already exists. Let that sink in. That's money that doesn't build roads or pay teachers or fund our military. It just services old borrowing.
So here's the real reason for this RMP program. When the government has to borrow trillions of dollars, it needs a ton of buyers for its bonds. If there aren't enough buyers, interest rates have to go up to attract more people. By stepping in as this massive buyer who doesn't really care about the price, the Fed keeps borrowing costs manageable for the government. But that action has consequences for the rest of us.
Now, this quiet intervention isn't happening in a vacuum. It's actually creating some very strange signals in the market. Divergences that every investor, whether you're big or small, should probably be paying attention to. Right now, we're seeing this major disconnect. The bond market, which people often call the smart money, is flashing some serious warning signs. Its fear gauge, the MOVE index, has been climbing. But at the same time, the stock market's fear gauge, the VIX, is just chilling out, staying strangely calm. This is a tension that just can't last forever. Somebody's wrong here. And even if you look under the surface of the stock market, you'll see a massive rotation happening. Money is flowing out of those big tech and digital-focused stocks and into these so-called boring sectors, the ones that produce actual physical goods, energy, materials, industrials. It seems like in this uncertain world, investors want to own real, tangible things, not just digital promises. So, after all of that, what does this actually mean for you and your portfolio? Let's try to boil this all down to the essential takeaways, the things you should really be watching. Okay, here are 4 critical things to keep on your radar. First, watch the 10-year Treasury yield. That 4% level is like the market's current line in the sand. Second, always remember that today's liquidity can easily turn into tomorrow's inflation, and that affects your real-world buying power. Third, keep an eye on that weird gap between the nervous bond market and the happy-go-lucky stock market. And finally, be aware that while that real asset trade has been strong, it's getting pretty crowded. You probably don't want to be the last one to the party. At the end of the day, what this whole situation really shows is that knowledge and diversification are an investor's best friends, because it all leaves us with one final crucial question to think about. In a game where the people who make the rules can also print the money, how do you make sure you're prepared for anything?